From New York City, for our viewers worldwide, I'm Matt Miller, in for Jonathan Ferro. We see futures down across the board in a reversal of the gains we had at the close yesterday. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, President Biden heads to the UAW to join the picket line. And the shutdown showdown continues as the House returns in Washington, D.C. Plus, Jamie Dimon fires a warning shot over higher rates that we hadn't even really thought of. Let's start with the big issue, and that is rate expectations.
We have high for longer rates.
Rates are higher for longer.
To digest higher rates for longer will take time.
Markets are going to have to accept that they really are willing to keep interest rates higher for longer.
Our concern is that they are going to keep rates too high for too long.
We're skeptical they can actually keep rates that high for that long.
They're going to have a very hard time justifying keeping rates as high as they've been.
Rates are somewhat too high over the long run.
I don't think rates need to go any further than where they are today.
The economy is slowing. Inflation is decelerating.
Inflation is already coming down and headed in the right direction.
Core inflation is going to fall a little faster than the Fed expects.
I don't see us going to 7%.
Even if rates were to go to 7%, it's not an immediate reset across the board for the consumer.
The impact of 5% Fed rates is coming.
They're going to just wait until something breaks either in the economy or markets or both.
Joining us now, State Street's Lori Heinel and Eric Knutson of Neuberger Berman. Now, nobody there mentioned 7%. In fact, I haven't heard anybody mention 7%. It wasn't even in, the realm of thought until J.P. Morgan CEO Jamie Dimon warned the world that we're not prepared for that. No kidding, in the times of India. Lori, what do you think about Jamie Dimon bringing up 7% seemingly out of the blue?
Well, it is out of the blue, and certainly that's not anywhere in our trajectory at all. But what we find when you have these kinds of dialogues is that the sentiment always swings to the extreme. So I think it was more provocation than really think that we're going to see rates at that level.
Is he maybe opening up a path for the Fed to go even higher?
I certainly don't think the Fed is going to weigh on what Jamie Dimon says, with all due respect to Jamie Dimon. I think it's going to be more about what is the inflation trajectory and how is the resiliency of the underlying U.S. economy evolving. Our view is that they've actually done enough already. Obviously, rate hikes follow through with a lag, and we see 2024 as being quite a precarious position. So we don't think that 7% is anywhere in the Fed's mindset at this juncture.
Eric, what do you think about higher rates for longer? I mean, that's much higher, 7%. Most people, I think, expect that we stay here or maybe go 25 basis points more in November.
Yeah, I mean, we agree in general with the higher for longer view, not 7%. But we also think the Fed is likely done at this point. So it's more about what happens along the curve. And our view is that what we're really talking about here is a shift from volatility in the bond market from the short end of the curve towards the long end of the curve as investors struggle with how our deficit's going to be financed going forward. And so where we see the opportunity is more in the shorter end of the yield curve, say 2 to 7 years, and then the potential for continued steepening as the volatility shifts to the long end.
We have seen people going longer duration. That's been a bad trade. Do you think that needs to be reversed?
That's what we would say. We've taken some duration off. We think that while the Fed is probably at the 10-year Treasury is probably at the high end of the range, you do have this risk of longer yields continuing to have pressure on them. Based on supply and demand and some of these long-term challenges around term premium, the notion that not only are we going to be higher for longer, but real yields are going to be higher. So we want to be, more in that intermediate and in portion of the curve where there's a lot of opportunity and we paid plenty without taking on that additional duration risk.
All right, investors are going to be digesting a busy day of Fed speak. that we had yesterday, with more to come throughout the rest of the week. Bloomberg's Michael McKee joins us now for more. And Mike, I wonder if anyone's going to respond to Jamie Dimon's fascinating float of a 7% possibility.
I doubt it very much, but we'll look at that in just a second. I want to first show you why people are concerned. This doesn't justify 7%, but it does show you what the issues are on Wall Street and for the Fed. The white line is the new Bloomberg Economic Survey out today. Economists across Wall Street and the U.S., what they think is happening with growth. The number doesn't matter so much as you can see the trend. It's getting stronger. And then we have the 5-year forward. Here's what the markets are thinking is going to happen with interest rates. As growth goes up, interest rates have to go up as well. So that sets the stage for what's going on. We have had Fed officials talking, and while they're not committing yet, except for one, Michelle Bowman, they're basically saying there's a good chance we could see rates go higher. Neil Kashkari last night, rates probably have to go a little bit higher. Bowman says they will likely be needed, and Susan Collins said it's not off the table. There is still a group that, well, I guess what you would call doves, what passes for doves these days. Austin Goolsbee yesterday says we may be on the golden path, but there are a lot of risks, and the path is long and winding. And then Mary Daly said earlier that we'll be watching. We'll see what happens with rates.
That's good to
know.
know.
Let's talk about what, sort of what Jamie Dimon said and sort of what's going on here. People are concerned that rates have gotten very high. And to that, I just say, oh, you kids these days. You go back and you look at real rates, and hat tip to Nick Colas from DataTrek for this. You look at real rates over history. This is the 10-year. And basically, they track the inflation rate at about 2%. And so if you're going to have a 2% real rate, you're probably going to have a 4 to 4.25% nominal rate. And that's what happened through about 30 years until we got to the great financial crisis and the Fed pushed rates down. So we may be just normalizing rather than seeing something unusual in the markets.
All right, fascinating stuff. What's your take, Mike, on Jamie Dimon warning that 7% is way too much for this economy?
Well, I don't know the question he was asked, but basically 7% would probably be too much for the economy, which is why the Fed wouldn't do it. If it put us into recession, which it likely would, they'd be cutting rates. And they also would know that it would be an issue, so they probably wouldn't even go there. Markets might price something like that, and then we would see an economic reaction to it. So I don't think 7% is realistic at this point. You'd need an awfully large increase in inflation.
Yeah, I just thought it was pretty amazing to see that story in the Times of India. Michael McKee, thanks very much for that. Let's get back to Lori Heinel and Eric Knudsen. And Lori, what do you think about the possibility of a soft landing, or maybe does 5.5% even push us into a recession? Because we're already looking at a consumer that's spent all of his savings, is putting more purchases on credit cards. Delinquencies there are ticking up. Delinquencies on auto loans are ticking up. We've got a UAW strike that threatens to go on longer. We're very likely to see a government shutdown. I mean, the headwinds are there, right?
They definitely are. But the U.S. economy has proven surprisingly resilient. Certainly, the consumer still has more capacity to spend, and as long as labor markets remain strong, which we see nothing in the immediate future that compromises that, we think that we're going to sort of mutter along. We don't have any recessionary impulses forecast for 2024, although interestingly enough, the longer that the Fed stays higher, the more likely you do see some sort of contraction in late 24. So 2024, early part of the year, probably still more of the same, 1% growth, that sort of thing here in the U.S. But we continue to push back that danger zone. And now the back end of 2024 looks quite precarious.
Eric, what's your expectation for the U.S. economy?
We agree with Lori that the short-term, setup is still reasonable, muddle along, or even, a fair amount of short-term strength, whether it's the consumer unemployment, still fiscal, significant fiscal spending. But as you get into 24, we don't think we're out of the woods yet. Consensus growth forecasts show declining expectations of growth in 24. PMIs are not, constructive and other short-term leading indicators. And so we see a potential conflict. Certainly there's recession risk, but even if it's just slowing growth, both real and nominal, a conflict between the top-down forecast and what's currently priced into equity markets, where GDP or EPS growth for the S&P is expected up 10 to 12% next year. We think there are some potential challenges with realizing that kind of growth given in earnings, given the overall economic setup.
I mean, the oil price is one thing that I find fascinating, and Ferro and Abramowitz both have been talking about whether this is, a demand-driven rise in price that we've seen, or is it simply because of supply cuts? Will that push us into a recession? What's your take on $90 oil, Eric, WTI, 93 on Brent?
Yeah, it's a contributor to part of why the setup for 24 is challenging. We think inflation is going to, while it has been declining and could decline further, is going to be sticky, and not just the last mile to target inflation, but the last number of miles to target inflation is going to be challenging for policymakers. That's going to lead central banks to stay higher for longer, even if they don't have to raise policy rates, but not cut them as soon as perhaps investors are forecasting. You combine that with, as you highlighted, challenges from the wage side, changing relative power of labor versus capital, deglobalization, and increased friction in the global environment. And we think that inflation is not just going to be higher in the short term, but is potentially structurally higher. So that is another challenge on that 2024 expected earnings per share on the margin side, and a reason for us to be on that 12 to 24 month horizon more cautious, more defensive, want to be more oriented toward defensive holdings in client portfolios.
Lori, what do you think? I mean, do you get more defensive here? We've seen the S&P 500 come down below 4,400. The NASDAQ, I think, off 8% from its July highs. Small caps are down 11, 12% from the July highs. Do bonds look a lot more attractive to you right here?
So we've been sort of barbelled here. First of all, in our bond portfolio, we've still held relatively high levels of cash, nearly 10% in cash, because we think clipping that coupon at 5% or better without any risk is actually pretty attractive in here. And we've also maintained a little bit of long duration, in part because we don't want to try to call the bottom here, but we do think that yield levels on 10 years and 30 years right now are pretty attractive on a relative basis. But we also think that the U.S. is pretty resilient. And with the back off that we've seen over the past couple of weeks, we think that U.S. equities, while they're not, sort of super cheap, certainly the entry point right now is pretty good. And given the underlying strength in the economy and seasonality, we're still a buyer of U.S. equities here.
All right, Lori, you're going to stick with us. Eric, you're going to stick with us. I want to get right now, though, over for a look at stocks ahead of the opening bell to Abigail Doolittle. Abby, what have you got?
Well, Matt, we do certainly have U.S. futures under pressure. And while big tech is a big piece of it, we have a number of idiosyncratic stories that are also weighing. First of all, Alibaba shares of that ADR down about 1%. This after they announced that their logistics arm is going to, or has filed for a $1 billion plus Hong Kong IPO, the first of several spin-outs. Investors right now seem to be not liking that, or it could be the overall tone in that part of the world. Sirius XM Radio down 9.23%. This is Liberty Media is planning to split off Sirius into another unit with the rest of Sirius XM Holdings. They already own about 83%. Investors seem worried there. Messy situation. And then finally, United Natural Foods plunging down 20.2%. They issued a profit outlook. The quarter that they reported was okay, but the profit outlook, it missed the average analyst estimate. And they also did add 3 new members to its board as part of the ongoing customer and supplier focused transformation plan. Look for other food suppliers to be under pressure as well, Matt.
For a long time, we called that a profit warning, Abby.
Yes.
The term was banned, I remember distinctly, about 20 years ago, but I think we could bring it back. Profit warning at United Natural Foods. Abigail Doolittle, thanks very much for that. Coming up, Biden heads to the UAW picket line.
I think the UAW gave up an incredible amount back when the automobile industry was going under. They give everything from the pensions on, and they save the automobile industry. Well, I always supported the UAW.
That conversation next. This is Bloomberg.
I think the UAW gave up an incredible amount back when the automobile industry was going under. They give everything from the pensions on, and they save the automobile industry. And I think that now that the industry is roaring back, they should participate in the benefit of that. And if you take a look at the significant increase in salaries for the executives and growth of the industry, they should benefit from it. So yes, I always support the UAW.
President Biden is going to head to Michigan and try and bolster his pro-union credentials, joining UAW workers on the picket line, potentially, as their strike against Detroit's Big Three continues. Union President Shawn Fain reportedly set to join the president as negotiations continue, but the UAW continues to withhold an endorsement for Biden as he runs for re-election. Let's get to our team coverage. Bloomberg's Anne-Marie Hordern joins us, as well as Kaylee Lyons, both out of Washington, D.C. So, Anne-Marie, what do we know about this trip, and will he actually stand on the picket line holding a sign?
It does look like POTUS is headed to the picket line. That is what the White House is trying to signal and triumph with this move. They're saying it's unprecedented for a president to join a strike. So that says to me he'll be out there shaking the hands and meeting UAW workers who are on a picket line. I think that's the closest thing you're ever going to see to a president of the United States joining a picket line. Not sure if he'll actually pick up a sign or not, but that's what he's going to be doing. Unlike the former president, who I believe will just be giving a rally tomorrow, really in some counter-programming to the Republican debate, the Republican presidential debate that'll be airing on Fox News. For this administration, even though the president is walking a very tight rope right now, continuously asked yesterday at the press conference, Karine Jean-Pierre said that they are not trying to weigh in on negotiations, but the president wants to stand in solidarity with workers. He'll be taking that chance today when he heads to Detroit.
Kaylee, aren't those workers going to have some questions for President Biden about his EV push? I mean, part of this is about the concessions they made post-financial crisis, but a lot of it is about that EV push coming from the White House that they're concerned threatens their jobs.
Yeah, this is one of the fundamental difficulties for the Biden administration, because while he is trying to be the most pro-union president in history, as he has self-described himself, he also has this big push toward electric vehicles, and is the future job security of a lot of these workers, and frankly, what their wages will look like in a more EV-centric world, that is one of the fundamental issues in these talks. This isn't just talks about wages, although the union remains far apart from all three automakers on that subject, but also the issue of job security, in addition to pensions and everything else that we have seen in the past, Matt, as you allude to. Now, as for progress on those conversations, we know that Ford, of course, was spared the escalation last week because of progress in those talks with that specific automaker. The union said yesterday that those talks are very active, though there is still work to be done on a contract. What is interesting, though, and this ties back to EVs, is Ford's decision yesterday to pause construction on a $3.5 billion battery plant in Michigan. That was due to scrutiny on the part of Republican lawmakers because of ties to a Chinese company. The union has blasted that decision. Shawn Fain called it shameful. So that could be something that is maybe coloring these talks as they move forward, Matt.
Yeah, absolutely fascinating developments with that battery factor, because that is actually quite old news, that partnership. In terms of former President Trump, Anne-Marie, he's going to go there, as you pointed out, and it's kind of counter-programming to the Republican debate that he's going to skip. But he's also looking for support from a union whose president has said pretty unequivocally, you're exactly the kind of person that we're against here.
Well, that's exactly what Shawn Fain said. He said it's billionaires like the former president, Donald Trump, that they're actually standing up against. The issue, of course, is that Trump knows that he's made indents and inroads with rank and file of labor unions. Even if top brass decides that they're going to endorse a Democrat, we should note UAW has yet to endorse a candidate. It's not going to be the former president, Donald Trump, that they would endorse. But rank and file, we have seen flip in the past, according to pollsters from Democrat to Republican, and Trump's trying to get them back. Remember, he flipped Michigan in 2016.
All right, Anne-Marie Horton and Kayleigh Lyons coming to us from Washington, D.C. Thanks very much for that. Let's get back to Lori Heinel and Eric Knudsen. And Eric, let me ask you how much of a threat this strike is to the Fed's job of bringing inflation back to 2%. Is it concerning?
It's one of the elements. It's as I mentioned earlier, we're in the midst of seeing a change between the relative power in labor and capital. These are long-term relationships. We had a long period through globalization where capital and corporate profits got more of that share of economic outcomes. We're seeing that begin to shift. That's partly associated with policy. It's partly associated with demographics relative, the fewer workers and tighter workforces. That should lead to higher wage pressures, and that'll play out both in manufacturing costs, but also in the service economy, which is more driven by wages and a larger portion of the U.S. economy.
Lori, what's your take on, the strike going long? It's a problem, right? Does the government shutdown matter?
Well, all of these matter through a couple of lenses. First and foremost is what is the trajectory of inflation? And nobody wants to revisit a 1970s style wage price inflation spiral. So to the degree that there are significant gains made by the unions, that raises the specter that translates into inflationary impulses in wages in other domains. The other piece is just uncertainty. Investors don't like uncertainty. So while you're seeing a lot of sell-off in markets be related to rising interest rates, there's also this concern that there are other things that just cloud the outlook. The data is very unreliable right now because it's skewed by a lot of these idiosyncratic factors.
Yeah, well, and as Mike McKee points out, if this government shutdown happens and goes on, we could get much less data. Lori Heinel there from State Street and Eric Knudsen from Neuberger Berman, thank you very much for joining us. Coming up, the morning calls, and then later, Aaron Kennan of Clear Harbor joins us around the opening bell with his take on the higher for longer narrative. This is Bloomberg. 5 minutes ago until the opening bell, and we're seeing futures down across the board on this Tuesday morning. Let's get to your morning calls. First up, Piper Sandler initiating coverage of Foot Locker with a neutral rating and a $19 price target, waiting for signs of execution amid a challenging macro environment and a lot of shrink. Next up, Oppenheimer naming Domino's Pizza a top pick, raising its price target to $450, seeing the company as an underappreciated revival story into 2024. And finally, Stifel lowering target to $130, maintaining its hold rating, pointing to likely decelerating consumer spending in mid-September. Coming up, we're going to get back to the Fed's path forward with Aaron Kennan of Clear Harbor. This is Bloomberg. Welcome back to the Open. We're looking at futures that are down across the board on the equity indexes right now. Just about to hear the closing bell, and it could be a reversal of the kind of risk-on close that we saw yesterday at 4 o'clock. There, you hear the opening bell on the New York Stock Exchange and the NASDAQ. Let's flip up the boards and take a look at some of the other asset classes that Ferro likes here. 105.94, dollar strength pushing the euro down. The 10-year yield reversing course today, but still over 450 at a more than a decade high. 2007 was the last time we saw 450, 451, 452. And NYMEX crude under $90, but just at $89.40 is off 28 cents right now, and we see Brent holding under 93. One of the stocks to watch at the open will be Tesla, the EV maker, under pressure after our reporting that the company is caught in the crosshairs of an EU anti-subsidy probe into Chinese EVs. Bloomberg's Abigail Doolittle has more on that story. Abby?
Yeah, Matt. Matt, it turns out that it's not just NIO that's coming and other China manufacturers of EV that's coming into the spotlight. If you recall, just last week, we were talking about this EU investigation into subsidies for China EVs. The EU conceivably trying to protect some of their own automakers that are pushing and producing EVs that are generally perhaps a little bit more expensive than some of the ones coming out of China. But it turns out no one ships more EVs produced in China to Europe than Tesla. And an early investigation suggests that Tesla has, in fact, benefited from those subsidies. The aim of the EU investigation will be to determine whether and the degree to which China has subsidized Tesla and some of those domestic manufacturers. Now, Tesla started producing or exporting, Model 3 sedans built at its Shanghai factory in late 2020. As of this year so far, they've exported nearly 94,000 made-in-China vehicles to Europe. The next largest amount is, and that's 47% of the deliveries from China. The next largest is closer to 58,000. China to Europe, then, for Tesla, Matt, represents about 5% of Elon Musk's whisper number target for the end of this year of maybe 2 million vehicles to be produced and delivered, a little bit above the official number. On the year, the stock well off of its highs, nonetheless, still up 97%. So it's going to be interesting to see whether or not this story weighs on the stock as time goes on.
Yeah, I think it's absolutely fascinating because, of course, those cars are assembled in China and then exported out. But all cars have a ton of parts that are made in China. They're just assembled elsewhere. So I guess it depends on how important you think the actual assembly process is. Abigail Doolittle, thanks very much for that. Turning now to the sports betting industry, J.P. Morgan upgraded DraftKings to overweight from neutral, writing that the company has, quote, a strong product, scale, and brand that should allow it to compete against new entrants like Penn's, ESPN Bet, and Fanatics, and like it competed against Caesars. Bloomberg's Katie Greifeld joins us now for more on sports betting. Katie?
Yeah, Matt, you can see that DraftKings currently up about 3% after that vote of confidence from JP Morgan. Like you said, upgrading DraftKings to overweight from neutral. And analyst Joseph Greff saying that basically buy into the stock's recent weakness. If you look from late July into yesterday's close, DraftKings had been down about 16%. But the sports betting industry overall is attractive right now. The industry as a whole is cutting its expenses, and specific to DraftKings, like you mentioned, it has a strong moat in that product, scale, and brand. You add that all together, and that should allow DraftKings to successfully fend off some of its competitors here, which seem to be growing by the day. JP Morgan, rather, it also boosted DraftKings' year-end price target to $37. Previously, it had been expecting DraftKings to end 2023 at about $26. Currently, shares trading, as you can see, at about $28.30.
All right, Katie, thanks very much. Katie Greifeld there on DraftKings. Now let's get over to the beauty industry. Coty fluctuating after launching an offering of 33 million shares as part of its plan to add a Paris stock listing. Bloomberg's Simone Foxman joins us now for more on Coty. Simone?
Yeah, Matt, Coty making this announcement yesterday after the closing bell, talking about how this offering would be to the public in the United States and via private placement outside of it. But really, this is a part of that plan to list on Euronext Paris. And the idea behind this offering would be that it would open the company up to a new class of European investors. Paris is where the company was founded back in 1904. It's also the place, EMEA at least, where the company does about 45%. That's the largest segment of its overall business. And in May, the company calling Paris the historic home of beauty. And so an offering there would allow the company to trade alongside LVMH, L'Oreal, Hermes, Kering, etc. It is a plan that the company has been floating for a while, and now particularly a good time to do it, perhaps because the company last week raising its revenue guidance for the first half as well as for the fiscal year, looking at 10 to 12% growth in sales just for the second part of this calendar year, with especially strong launch of Burberry Goddess fragrance. Shares are close to 3 times the value they were when Sue Nabi, the current CEO, came in September 2020 to try and rebuild this company. We're seeing a little bit of a reaction here today, a negative one on this dilutive impact. But overall, this has been a really positive market story so far this year. Shares up 34% despite some of those declines today, year to date.
All right, Simone, thanks very much. Simone Foxman there talking to us about Cody. Let's turn back to the Fed. Why don't we? The market's been open for 3.5 minutes already. Aaron Kennan of Clear Harbor weighing in on a higher for longer narrative, writing, quote, the Fed's approach to their last meeting was to announce data dependency, yet suggest they are inclined to see the whites of disinflation's eyes before they cut rates. We know why they are taking this more hawkish approach, as they enter the inflation fighting process too late and received heavy criticism from market observers. This increases the profitability that they overstay, or sorry, the probability, I should say, that they overstay their welcome. And really, do they have any other choice? Aaron, I'm pleased to say, joins us now. They have to err on that side, don't they, Aaron? Because if they don't, and then inflation comes back, I mean, Jerome Powell's worst fear must be to look like Arthur Burns.
Sure. Yeah, Matt, thanks for having me. Certainly, that is a concern. Powell has made reference to that he's going to be more of a Volcker in this regard. But I do think this economic picture is certainly far different than the one that we saw in the late 70s and the early 80s. And so I think the Fed is jawboning the market. I think they're doing what they want to do. They pulled the growth forecast up, and they removed the 2 rate cuts in 24 in their dot plot. And I think that doesn't speak to the reality, which may be that growth does really start to tank in 2024, and the Fed needs to pivot. And I think they're willing to do that. They've shown that in the past, but they have certainly convince the market that they're not of that mindset at the moment.
So they have 2 mandates, obviously, employment and inflation. Is one more important than the other right now?
I think the Fed is clearly focused on the inflation picture. And I think that, while they are now of the view that maybe we can experience a soft landing without having an employment crack, we'll have to see how that all works. Employment's usually the last leg of the stool to drop as we go into a recession. And I think that that's really been the narrative of 2023, which has surprised the markets, which is the resilience of growth. We have seen inflation drop significantly, Matt, and from that 9% odd headline number back in 2021 to, now below 4%. And PCE month over month, if you look at that data set, is pretty close to the Fed's target. So we've made a lot of positive gains in the marketplace, and yet, bond yields are higher this year, which has been quite surprising. But I certainly think that the Fed's looking at the dual mandate. They certainly would rather not see employment crack and see inflation move down. But we've made a lot of progress on the inflation front. I think the Fed's aware of that, and they're more inclined to pause, maybe raise rates another 25 basis points. I think the sort of risk reward of is about equal, where they raise 25 basis points within the next 6 months versus cut 50 basis points within the next 6 months. But again, they're certainly not going to comment on that until they see growth crack.
What kind of crack? What do they need to see, Aaron, in order to start cutting rates?
Well, I think we're starting to see the consumer certainly under some pressure, whether it's the savings rate, whether it's the lines of credit on their credit cards. You can see the revolving lines of credit extending. You see mortgage rates well over 7.5%. But as some data indicates, which is I believe is accurate, only about 9% of American mortgages, American households that have mortgages are over 6%. And the vast majority are into that 3% and 4% mortgage rate because we've locked them in prior years, which is one reason why there hasn't been much mobility in the housing market. But it's another reason why monetary policy does work with a lag. And it may take some time. But I think what we anticipated seeing in 2023, which was a modest recession or the increasing likelihood of one, may just be delayed to 2024 as these sort of forces come home and are brought to bear in the market. You have credit card rates, Matt, at 21%. And you start to see the retail sales data has been weakening, and the weekly wage data for the monthly wage data for the month of August suggests that there's far less buying power occurring on the wage front too. So we anticipate a slowdown in 24.
You know what? I am in the habit now, Aaron, of listing all of the headwinds that we have for growth, from depleted savings to credit card usage to, auto loan delinquencies. On the other hand, we've seen oil rally up to $90 a barrel here. You see gas prices continuing to rise, and conventional wisdom is that suggests an economy that's growing. Is that what's happening here?
That's a great question. I believe that has been conventionalism, because over the course of history, that there's been a high correlation with economic growth and the directionality of oil. This coming year, and maybe even starting, with the most recent upward move in oil prices, may augur a different narrative, where we see tight oil supplies globally, and we have participants who control that incremental production, who are less than friendly to the Western world, and particularly at a time of geopolitical uncertainty, strife between, the United States and China, but particularly the war in Ukraine, and the ability for Putin to sort of crack the Western alliance's will, I think is perhaps on his mind. He certainly could do it by reducing or removing for some short period of time oil production, exporting from Russia to places like India and China. And in doing so, we could see a significant spike in oil, even as growth is expected to trend downward in 2024. More markedly in the United States, we expect growth to go from 2% to maybe the first 3 quarters. We could have negative growth in 2024. Global growth may be less impacted in 2024, just because of the fiscal stimulus here in the United States has been so strong, and that's starting to peter out. But I do think that there's a real risk that oil prices trend higher in the midst of a slower global growth picture due to these decisions that may be made by less than friendly people in the world.
Well, and we could see auto prices go higher again. Aaron, we barely recovered back to MSRP, but this strike could push that, as well as wages for at least 150,000 people. I would expect more as non-union shops look and say, I want that pay. Are you worried about the inflationary pressures of this, potential inflationary pressures of this UAW strike?
I think it's something worth certainly monitoring. It's something that we have been, closely monitoring. But, at the end of the day, we think that, when we look sort of medium term, long term, it's probably less of an impactful narrative on the overall economy, even though it's certainly headline news of late. The president's going out there and striking with the workers. I think most market prognosticators and media people would not have predicted that even 2 weeks ago.
Well, we may not have thought a few months ago that the government would essentially strike due to some Congress people who don't want to vote for funding. Is that going to be a concern at all, or is this just kind of par for the course now?
It's interesting. There's been jockeying around government shutdowns for years. The last one didn't seem to rattle the market. I fear that we are on a sort of walking a high wire act as it pertains to, this constant sort of kicking the can down the road on the shutdown plans. I mean, it seems like the narrative right now is that there's a temporary 4 to 8 week potential fix in the works. I mean, we're the largest economy in the world. The world looks upon us for leadership, and we have people in Congress who can't sort of recognize that compromising and moving down the ball down the field on behalf of the American people is in the best interest of our country. It's quite sad to see it.
All right, Aaron, thanks so much for joining us. Aaron Kennan there from Clear Harbor talking to us about the Fed and the various pushes and pulls affecting that body. Coming up, lawmakers scrambling to avoid that shutdown we were just talking about.
Our partisan politics are not going to resolve this issue, let alone really confront the huge fiscal issues that are the things we should be talking about. Our politicians are promising not to do the things that we actually have to do to fix the budget.
Our team coverage up next. This is Bloomberg.
Just a few months ago, the Speaker of the House and I agreed to spending levels for the government. We were up right to the very edge, almost reneged on our debt, and that we're going to fund essential priorities and still cut the deficit by $1 trillion over the next decade. Now, a small group of extreme House Republicans, they don't want to live up to that deal.
I'd be shocked if the Senate passed anything. They were supposed to pass any appropriation bills for the last 3 weeks. They haven't passed one.
It is crunch time on Capitol Hill. The Senate nearing a deal on a short-term spending measure intended to avoid a government shutdown at the end of the week. They have to do the work because the House apparently isn't. Moderate Republicans are teaming up with Democrats on a rarely used procedure to force a vote on the floor. We'll see if that works. But in the meantime, Moody's signals confidence is wavering ahead of Saturday's midnight deadline, writing a shutdown would, quote, underscore the weakness of U.S. institutional and governance strength relative to other AAA-rated sovereigns. Let's get to our team coverage. Bloomberg's Kaylee Lyons and Anne-Marie Horton are in Washington. And Anne-Marie, first walk us through what the Senate bill is going to look like and how this would work and for how long.
Well, Senate Republican and Democrat negotiations have been working through the weekend, and when they're back this morning, they plan on voting on the FAA reauthorization bill. That bill can serve as a shell to put through a stopgap funding measure to keep the government working. This is federal spending that is going to run out after September 30th. It would be for 4 to 6 weeks. Questions remain on whether or not disaster relief will be included or Ukraine aid, which you do know that some members on the House Republican side say they cannot vote for. But really what this comes down to is if the Senate is able to pass this through and they send it over to the House chamber, will Kevin McCarthy, the Speaker of the House, put it on the floor? Because if he does, this will likely be a centrist vote. Moderates from both parties will vote this through. But it is the hard right flank. Some members have threatened to oust him over putting a bill like that on the floor. So then this would become a very tricky pickle for him to get out of.
Yeah, God forbid some legislation go through in a bipartisan vote. Kaylee, is there any way the House can force the vote?
There is, Matt, but it is a very difficult one to execute procedurally. This discharge petition has only been successfully used twice this century. Basically, it would require all the Democrats in the House plus 5 Republicans to get on board with this discharge petition that would go around Speaker McCarthy. The thing is, even once it gets all requisite signatures, 218 of them, they still need to wait 7 legislative days to actually bring it to the floor. So there is no way that this would work in time to avert a shutdown on October 1st. We have to keep that in mind. It also could have pretty catastrophic political consequences for Speaker McCarthy. As Anne-Marie says, he's in quite a pickle. Matt Gaetz, the Republican from Florida, told me and a group of reporters last week that any Republican who works with Democrats will be signing their own political death warrant. That really just speaks to some of the dysfunction we are seeing on Capitol Hill at the moment. And it's that very same dysfunction that triggered that warning from Moody's yesterday. They talk about weakness in governance and political partisanship, that really polarization. That is why they are saying the creditworthiness of the U.S. may be in question. Remembering, of course, Matt, Moody's is the only of the big 3 ratings agencies that hasn't downgraded the U.S. Fitch and S&P have done the same, both of them citing governance and discord in Washington as the reasons why.
All right, really interesting stuff. Obviously, we're going to be following along. Anne-Marie Horton and Kaylee Lyons, thanks very much for that. Now, for some of the sector price action that we're seeing this morning, since the stock market has been open for 22 minutes, let's get over to Bloomberg's Abigail Doolittle. Abby?
So we're seeing a bit of a sell-off here for stocks. Not a major one, Matt, but we do have the S&P 500 down about 0.8%, down 5 out of the last 6 days, down more than 6% from the late July peak. Sector-wise, you can see right there, a sea of red on the screen. All 11 sectors are lower. We have a few of them down by about 1%. Those are the mega cap tech sectors. So even though yields are a little bit of a reprieve today outside of the 2-year yield, investors remembering that pain from yields over the last 5 days, Matt, all 11 sectors are lower. And it's interesting because real estate down the most, of course, getting hit by those sectors, the yields going higher, making the dividends look less attractive, although discretionary at this point is taking that lead. Financials, too, can't catch a break. Bearish activity.
All right. Interesting stuff as this market really has been in a downdraft over the past couple of weeks. Abigail Doolittle, thanks very much for that. Coming up, the market-moving events that you need to be watching out for. That's next in our Trading Diary. This is Bloomberg. Time now for the Trading Diary. What you need to be watching this week. President Biden joining the UAW picket line at noon Eastern. We'll definitely show you that. Wednesday, the second 2024 GOP presidential debate without Trump. Fed speak picking up Thursday with Chair Powell, Goolsbee, Cook, and Barkin. Plus, we'll get U.S. GDP and another round of jobless claims. And finally, the government shutdown deadline coming at midnight on Saturday. This was the countdown to the open. For Jonathan Ferro, I'm Matt Miller. This is Bloomberg.